Dividends are a tax drag. Dividends destroy compounding. Young investors should absolutely avoid dividend-paying stocks. But did you know that dividends done right are a tax-efficient way to get income? Hear me out. It's not financial advice. I say that because qualified dividends are taxed at the long-term capital gains rate of 0, 15, or 20%. Most S&P 500 companies you invest in, outside of REITs, BDCs, and MLPs, they're taxed this way as long as you buy and hold and give it time to slow cook in the oven. And the best part is, by doing nothing at all, by investing into high-quality compounders, the dividend growth rate helps your passive income keep up with inflation. So it's important to keep in mind, not all dividends and distributions are taxed at your ordinary income tax bracket. Then, there are income-focused investments that almost feel like a tax cheat code, which is one reason why the NEOS ETFs like the SPY-E or the QQQI and funds like the Goldman Sachs GPIX or GPIC have become so popular. A large portion of their distributions are often categorized and classified as return of capital, otherwise known as ROC. So what are return of capital distributions? In simple terms, the income you receive is not always immediately taxed as ordinary income or dividends. Instead, the distribution lowers your cost basis in the investment, and the taxes are generally deferred until you eventually sell your shares, at which point your capital gain is calculated using that reduced cost basis. So rather than paying taxes upfront every time a distribution from SPY-E or BTCI hits your account, part of the tax bill can effectively be pushed into the future when you're going to be in a lower tax bracket in retirement. But I think the original argument still stands. Yes, taxes reduce compounding, but probably not as much as people think. The tax man gets us whether it's from passive income or from selling shares. But if it's dividends in a Roth IRA, you're safe. Since the contributions were already taxed up front, those dividends can compound and grow tax-free over time. And that's why dividend growth investing makes all the sense in the world, whether you're 18 or even 44 or 65 years old. Because there's one characteristic trait that we share in common when you adopt that long-term value investing dividend mindset, which is time, consistency, and reinvestment of the distributions to do all of the heavy lifting and to allow our portfolio to snowball into a monster. And that's why I fundamentally disagree with the notion that every single person under the age of 65 needs to be fully focused on growth stocks. There's more than one path to building wealth, and dividend growth investing has historically worked very well for patient long-term investors with a lower risk tolerance, because not everyone feels comfortable putting 100% of their capital into speculative, narrative-driven hype stocks. Because dividend-paying stocks are proof in the pudding, usually, not always, they're usually profitable businesses generating excess cash flow that they can return back to the shareholders like you and I. These are often mature and established companies with a business model that's already producing more cash than they need to reinvest back into growth or to throw money into random side projects or to just burn cash doing R&D. Instead of utilizing that capital poorly, management rewards shareholders through distributions and dividends. That's the whole point of investing into equities, right? To get an ROI. Dividends are one form of being rewarded for believing in the company and putting your capital into them. So when we think about Procter & Gamble, McDonald's, Abbott Laboratories, just to name a few, and honestly, amigo to amigo, when you compare how dividends are taxed versus how our regular income is taxed, the gap is pretty astronomical. At work, our salary every 2 weeks or every month, depending on the cadence of when you get paid, is going to be taxed according to our income bracket, which means every paycheck creates a taxable event when you receive your W-2 income. And what's really funny is, ironically, many people pay a higher tax rate on on their W-2 income than they do on qualified dividends. So, for instance, for someone like me, my qualified dividends are currently taxed at 0% because I'm a stay-at-home dad, and the Patreon and YouTube income is still very small. I'm thankful for you guys that the community is growing and everything, but the fact of the matter is the pay is pretty small. So that means essentially there's no tax drag at all when I get dividends from my investments. So what do? I usually store it in a money market fund. That way it can collect interest at like 3.5 or 5%. And then I strategically reallocate that capital and reinvest it into portfolio holdings, or when I see something on the dip or a high quality dividend compounder with cheese that's on the clearance, I'll buy it. So every dividend goes right back into my portfolio buying more shares. And once you start thinking long term, taxes suddenly become a much bigger part of the conversation, especially if you're anything like me and you plan on eventually living off your portfolio. For instance, in retirement, if nothing changes, and as it stands right now, I would most likely move back up to the Pacific Northwest, to Tennessee, Nevada, Florida, or even South Carolina, contingent upon their tax burden. And I would say Texas, but their property taxes are kind of high. And the weather is absolutely beautiful in California. I know because I went to seminary there, but the tax burden on dividends would be brutal, or potentially, maybe I'll go overseas. Then again, that should be a video for another day. What say you? Because my whole thing is, all else being equal, if you're gonna live off a dividend income, I think the tax drag argument should be something to take into consideration, especially if you're settling down in Hawaii. On the other hand, if we flip this upside down and take a look at it the other way around, Alaska would be number one. Property tax is about 3.3%. The individual income tax burden is 0%. Surprisingly, New Hampshire would be in second place. Tennessee is number 3. There's Florida, Delaware, South Dakota, Wyoming. We got Idaho to round out the top 10. There's Oklahoma and Arizona. And if we only take into account the 0% income tax burden states, it's Nevada, Texas, Wyoming, South Dakota, Florida, Tennessee, and Alaska. I mean, I've never been to Alaska, but one day I would most definitely love to visit and potentially ride a moose or two. Now, wait a minute right here, a little nuance. I was taking a look at Washington State. It says that the individual income tax burden is 0.13%. After looking into it, Washington State does not have a personal income tax on regular W-2 wages or from dividend income, but instead they impose a 7% capital gains tax on long-term capital gains that exceed $250,000 for only high earners. So qualified dividends would still be taxed at 0% in Washington. So despite all the hate dividends get, I still think they're amazing. There's something powerful about building a portfolio that continues paying you cash flow year after year while it's still growing over time, regardless of what the market decides to do. Whether the day is green, whether the week is red, it doesn't matter. That passive income keeps pouring in as long as you're invested into high quality dividend compounders with cheese. Now that's the vision for me. God willing, over the next 20 years, I want to eventually live off the income produced by my portfolio. I don't want to be working past the age of, say, 60, 61. Who is to say I'll ever get there, right? Not because I hate working, but because I value freedom, flexibility, and a peace of mind. Between you and me, dividend growth investing, that's going to help me get me there. So, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you next time. See ya!